W.P. Carey had a busy year of acquisitions in the self-storage business and is the 8th largest owner of self-storage properties in the U.S. Liz Raun Schlesinger is a managing director at W.P. Carey and head of self-storage. Great to see you.
Good to see you as well.
You were very busy last year. Let's talk about all that deal volume you had.
Sure. Last year was a particularly busy year for us. We tripled our deal volume from 2014 to 2015. I wouldn't say that we set out in 2015 to do that, but we felt there was a window of opportunity. We saw a lot of good opportunities. We actually underwrote 325 deals and completed 29 of those. So it had a lot to do with the volume of opportunities we saw, and then also digging in on specific deals, determining that we could provide good risk-adjusted returns on those deals to our investors.
So 2 questions in light of what you just told me. Why was that window there? And how is your strategy a little bit different when you're looking out and approaching a potential acquisition?
So last year, there were a few large transactions that were taking place. Extra Space was purchasing a large portfolio from Strategic Storage Trust. Both of those have been large players in the space historically, and they were out of the acquisition market because they were busy with that deal. There was another group that was being recapitalized, and so I really felt that we could play into that window without the traditional competitors in the space, as busy as they usually are. And then in terms of underwriting each deal, we look at a lot of metrics, discount to replacement cost, the demographics within a 3-mile radius, and then also the competition within that radius. Particularly now, given there is increased development interest in the space, we also look at whether or not there are any new developments planned within our competitive radius.
You like to make smaller deals. That's advantageous in your view. Why is that?
Well, I think that's partly because, as with anything, there is really no free lunch. And I think one of the things that attracted us to storage is that the risk-adjusted returns really are typically a little higher than in other asset classes where you can more efficiently invest your capital. So the smaller deals typically have a bit of a higher cap rate. And you basically are getting paid for all the work of doing those deals. I mean, doing 29 deals in 1 year is not an easy thing to accomplish. I mean, I obviously have a terrific team, and we're skilled in this space. We've been doing it for 10 years, so we do have the expertise and the parameters and framework to actually execute those deals, but it's still not an easy thing to pull off. And I think, that amount of work isn't attractive to everybody. And so therefore, we have found that we can generate higher returns doing those smaller deals as opposed to a more efficient allocation of capital buying one large portfolio. You typically aren't going to get the same returns on something like that because it's easier to do.
Yeah, it totally makes sense. What about this year? Is that window of opportunity still there? And do some of the macroeconomic concerns weigh into your world in 2016?
Well, what's interesting answering the last part of your question, and the reason why we really like storage, is that it has been a relatively strong performing asset class in recessions. I wouldn't say it's recession proof, but it was very resilient when you compare it to other real estate asset classes. So from an operational perspective, I don't think we're concerned primarily about significant deterioration in revenue or NOI. I would say that we saw, as did the public REITs, a deterioration in our revenue and NOI. It's not a good thing for our customers or for us when the economy isn't performing well, but it's certainly not as risky as a hotel might be, which is more countercyclical. With regard to how we see this year, I would say that there is probably likely to be still opportunities. We evaluate everything on its own merits. We aren't seeing quite as much volume this year as we did last year. We also do feel like some of our competitors are sort of recapitalized and back in the space. So we want to stay disciplined and focused on the right opportunities and achieving what we believe are strong risk-adjusted returns. And so we'll continue to work to do that.
Liz Raun Schlesinger, so nice to speak with you.
Thank you as well.
Thanks. I'm Rhonda Schaffler for The Deal.